Deep Dive with David Stendahl, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey there, it's David Stendahl with tonight's Deep Dive. It is June 3rd, 2019. Tonight I'm going to take a look at crude oil. The ETF on the short side is SCO. Now, the trend for the most part is to the downside, although we do have a mixed bag here. But the long-term trend is beginning to turn over, but right now officially it's not, and that's because of the fact that this sell-off that we've been seeing over the last, call it, month or so has been fairly strong, but it hasn't necessarily changed the general trend to the market. But I think that we're at a critical point here where it's a put up or shut up type period where it's either going to really start to take off to the downside, or we're going to start to see a little bit of a base. So with crude oil, we have kind of a mixed bag here on the technicals, which is what kind of drew my attention to the market. And we have a pivot low that's occurring here in the elastic level, a little bit of a bearish divergence that's popping up here, or excuse me, bullish divergence. And then there's a support gap that's up here that is basically telling us that if we don't hold here, that the market could really start to kick into gear. Hence the reason we're sort of at a critical point. So here is the market for crude oil. These are daily bars that we're seeing here. You can see the general trend to the downside is definitely on the quote-unquote bearish side, despite the fact that the longer-term trend is slow to really keep up with what's taking place. That bullish divergence that I'm talking about, we can see it here in the elastic level, where we have a low here in the elastic level, the yellow line here, and a higher low a couple of days later. With the low in the actual bar here, the actual open, high, low, close bar, you can see a low here and a lower low here in the market. So anytime we see that type of a condition, it's called a bullish divergence. The indicator is telling us that it was basing and wanting to head higher, while the market, the open, high, low, close data is telling us that it's really starting to sell off. That being the case, it's kind of a foreshadowing. So here we are. You can see with today's action that the market is on a support level right through here. They're both weak support levels, but they are support levels and they are showing up, despite the fact that they're just not as strong as we might normally see. Point being, if we don't hold at these levels, I'll just give you a number here, 52.61, then there's really not too much that's holding us here. And this next lower level, I know it's kind of hidden here, but this is strong support. You see all these dots along the way here. Strong support is at 43.65. That's what that represents. So if we don't hold here, yes, there's a bullish divergence, and there are certain things that we're looking for that might say that the market's going to base here. And if it doesn't, that's where that support gap comes into play, that there's nothing holding it. So if we come back to the website, anytime you see an S gap, that's simply telling you there's a support gap, meaning there isn't any support as soon as you break through a specific level, despite the fact that we're showing elastic level lows, and we're talking about the market kind of coming into a basing type formation. That support gap is always out there telling you that things could really start to kick into gear. Now on the positive side, if we take a look at, as an example, some of the pro alerts, you're looking at here some surge on the crude oil and RBOB and heating oil. We've got a pop that is popping up here, which is a kind of a reversal for that of crude oil. So there are signals, there are alerts that are telling us that the market should base, one of which is profit taking. If you're short, as we are right now, consider taking profits. This could be an early warning signal, pop being that case. The market has popped to the downside, and that it's perhaps gone a little too far, and it's looking to potentially base. Hence, again, the reason that you really want to be looking at the that support level that we were talking about. Now, I mentioned in a previous video back on the 22nd, kind of a similar type condition where there's a lot of things that were taking place. There's going to be low energy, which I'll talk about here, and certain key support levels, and the it didn't hold and it sold off pretty quickly. In this particular case, we're kind of in that same scenario, and I just want to prepare you for the opportunity to continue to actually make money here on the short side, which is what the systems are doing. So I'll just show this to you that the systems have 4 separate systems that are out there: weekly, a daily, another daily, and 120-minute bar. So we're kind of committed with the dailies and weeklies to the trend to the downside. So the one you'd want to look at is the Polaris 120-minute intraday system that is looking for the market obviously to continue to the downside. It's only been in a position here for a short while some of the other systems back on 523 and way back in 2018 that there's been opportunities where the market has actually done quite well for us on the short side. The weekly systems just simply stay in trades for a much longer period of time, and less likely to be in trades for a long time are going to be the daily bar systems. Now, talked about the trend. So here's our depth gauge. I'll show you where you can find this information. You just simply come to charts, depth gauge charts, and then pull up the market you're looking at, and this being crude oil right through here. You can see that the market, at least the depth gauge, did pick up on the reversal that took place up through here. You can see where it started to head to the upper side. But now we're kind of at, and this is a slow moving type indicator, you can see that it's starting to turn over. So it's a substantial sell-off, so much so that if this really does start to pick up and break that support level that we were talking about, and easily transition through that support gap, that will definitely get this particular indicator start to be a little more negative, and we'll go from a mixed perspective to a outright bearish type condition. Hence the reason I'm saying we're at that critical level. The other thing that's kind of interesting here, and I'll point this out, this is a volatility comparison, this against all of the different energy markets. Blue right through here, this is crude oil in itself. I just want to point this out, that the upper dot and the lower dot reference what kind of volatility do we have, how extreme is the volatility over a 3-year period. So the high obviously is this upper dot, the lower volatility is this lower dot, high volatility, low volatility. It's hard to see it, but there's a middle dot. I'll use this as the example here in natural gas. That is kind of the median, and you can see that for in this case for crude oil, this little diamond represents where we are right now, and that is sitting right on that normal level. These little dashes, I'll use natural gas again, this dash and this dash right there, they represent standard deviations away from the norm to give you an idea as to how strong the actual volatility is. Point being is that for RBOB, for London gas oil, for crude oil, forget about natural gas, that's kind of an entity to itself, but these particular markets in themselves, they're right on or very close to their normal volatility. Why do I say this? Because what we're seeing in the market, again, these are daily bars here for crude oil, you would think that we're in a high volatile period. The reality is, over the last 3 years, this is kind of normal. So there's a possibility of, and volatility doesn't really tell us too much, that either A, the volatility can pick up and this basing that we're talking about for support could really rally to the upside, or the market could use that volatility and really surge to the downside. Again, the reason I'm talking about crude oil is that really at a critical point where the volatility we've been seeing as of late isn't really, from a relative perspective over the last 3 years, really isn't all that strong. So watch the systems and see what they do. Obviously, they are much more bearish on the their outlook for the market with the systems and some of these trend-based type systems that are actually out there. So watch over those systems. They will give you, I think, a pretty good indication as to where the market is really headed, and support level that you're going to want to look at, the critical support, considering that we're there, at least, and we hit it on the low side through here. I'll just give you that number again, is 52.61. There's another one that's pretty close to it, which is 52.54. But if we don't hold here, then that next logical level, at least on daily bars, is going to be this 43.65 level right through there. So expect some fireworks, positive or negative. The systems will hopefully give us an indication as to where things are going, and you'll want to take advantage of those types of conditions here probably within the next say 10 days or so. That's when it should conclude itself, so expect some increased volatility. Best case scenario is that we basically hold at this support level and that the market just simply moves sideways and it finds some support, and depending upon how it interacts with that support level, it can actually act obviously as a legitimate support level and the market rallies higher. Or, and I think more likely the case, is that if we do base here, that eventually will break that level and we could actually see it hit those lower targets. You can see here with the yellow line is the 50-day moving average, and the gray line represents the 200-day moving average. Not saying that they're going to cross. They crossed obviously here not too long ago, and you would think that it would be bullish, which the market then sold off because of it. That there's potential for these to cross again with the 50-day, the shorter term, crossing below that of the longer term, and perhaps that you would think that would be a negative. Certainly didn't help us on the positive side, and may not help us on the negative side, but there is obviously some ambiguity that's going on here where the two moving averages are very close to one another, and they're feeling themselves out and trying to figure out where the market's going. Again, and I'm just simply harping on the fact that the market in itself is at a kind of a point of reference where it could go either way, and with the extreme case we've had as of late being very much oversold on the phase, and you can see that with the elastic level. Let's see how things kind of base here at this weird level. It rests and then potentially continues to the downside, because that would be most beneficial for the systems. If for some reason it reverses, starts to head to the upper side, hopefully we'd expect our systems to either hedge themselves on the long side or begin to unwind some of those short positions. Either way, watch crude oil, because there's something that's brewing out there, and it's certainly something that we can take advantage of. So with that, we'll look at another market tomorrow. Bye-bye.